Welcome to the Clark Howard Show, where our mission is to serve and empower you to make better financial decisions in your life. This is Christa. Clark is out again on Monday. Wes, when I asked you to come back, I bet you didn't realize it was going to be just like in a few days.
Again? Okay, good. I'm happy to be here. Excited to be back.
So that voice is Wes Moss. He is a fiduciary financial planner. And Wes is back with us because Clark's playing hooky today. He will be back tomorrow. And we've got a lot of investment questions, including some about Social Security in the second half that I'm going to ask you. That's always
Love
a
Social Security
big
questions.
topic for our audience. So what are you going to talk about today?
Well, there's a couple of things, right? In any given year, there's volatility in the market. And 2024, no different. We've had some really dramatic drawdowns and corrections, close to technical corrections, here in the United States and around the world. The Japanese stock market this year fell 12% in one day. And anytime you get that big of a market downfall or waterfall decline, it makes investors really nervous. And I think it's really important to think about what are some of the investing principles that will be on your side that you really need to rethink year after year after year so that you get to a point in retirement that you have financial and economic freedom. And one of those is staying invested and not missing just a few of the best days in any given year or even multi-year period. So I want to go over the numbers on missing just a couple really good days in the market, how much that can impact your returns to the negative. And second, this concept I call the dry powder principle. And that is trying to figure out how much in safety investment assets should you have in order to make your investing journey in stocks easier.
I love it. And I know that this audience is going to love it too. So, all right.
Okay, good. Let's do it. Are we doing questions or
No, you can talk first.
You
Your first topic.
Into best days of the market.
Yeah.
So there's a couple of things. And again, it's not just 2024. It's in any given year. You've got market corrections. In fact, the average drawdown over the last, call it 30 or 50 years in the stock market is about 16.5%. So in a normal average correction or drawdown in any given year, you're talking about negative 16%. That can hurt investors. And that's if you're invested 100% in stocks. And what that tends to do, anytime we get a drawdown, in 2024, it was about the carry trade unwinding and the Japanese stock market going down 12% in one day and the US stock market going down almost 10% in a really short period of time. That makes investors scared. And what it naturally leads investors to do is want to miss out on that. So wait a minute, maybe I should be out of the market and try to miss these bad days. And that's just a natural inclination. Hey, let's get out of the way so that when the market falls, I don't get hit with the downfall. The problem with that is that very often the best days of the market, which first of all, we have no idea when are going to come or how to predict them, but they often come right around the same time we have these big declines. So we'll get big spikes down and then things will linger and then we'll get big spikes up. And the historical data on this is really kind of fascinating. We all know that over time, the S&P 500 has averaged around 10% per year. What's crazy about looking at the study where I call this missing the best days is that over, call it a 25-year period, which there's about 252 trading days in any given year. So think of 25 years, 252 days, you're talking about 6,000 days. Imagine, so if you're fully invested during that whole period of time, and this data is from 1995 through July of 2024. And if you've been fully invested, reinvesting dividends in the S&P 500, you would have averaged just shy of 9% per annum, which is a really healthy rate of return and can do wonders for your retirement. Almost, it's 8.8 to be exact, but call it 9% a year compounded average rate of return over that period of time. But over that, call it about 6,000 day period, imagine you only missed 10 trading days. 10 out of 6,000. It's 0.16% of the days. But they happen to be the best days because we don't know when they're going to arrive. And we're going to have the gift of a big market up day. And if we miss just those 10 best days, our return goes all the way down from close to 9% all the way down to under 6%. With just 10 days. Let's take it a little bit further. Miss the 20 best days over that almost 25-year period. Now our rate of return falls all the way down to 4.1%. So we've missed 20 days now out of a 25-year period, and we've cut our rate of return in more than half. Take it a little bit further, missed the 40 best days out of this almost 25-year period. Now your rate of return drops to 1%. And at that point, why even take the pain of being in the stock market when you can just put it in a money market and you'll probably do better off than trying to hop in and out of the market? Because if you miss the best days by trying to miss out on the worst days, that's essentially timing the market, and your rates of return can go down dramatically. We know that the answer to this is that time in the market over time is how we really achieve our returns. And I think just some historical perspective here, knowing that missing out on a couple really good days almost defeats the whole purpose of long-term investing. So let's just understand that and be invested on the stock portion of what we're invested in. That's the way we realize our best returns over time.
Yeah, timing the market, not good. Learn my lesson on that.
Not time in.
People always panic, and something might happen, whether it's political or something in the world, and everyone wants to pull their money out, and it's just.
And by the way, that's just human nature, right?
Know.
And no one's crazy when it comes to investing because we all have our own unique blueprint of how we feel about money, how we were brought up. Are we conservative? Are we aggressive? And so it's natural that we want to step out of the way of some sort of bad thing happening. Only problem is that often we're whipsawed and then we miss the good days as well.
That's the worst. All right. Well, are you ready for some questions?
Let's do it.
Okay. Tim in Alabama wrote in. He says, I'm hearing some financial pundits warn of impending recession based upon increasing bankruptcy filings and noting concern with the inverter yield curve.
The inverted yield curve. I call that the upside down yield curve.
Do you have any thoughts on this?
I do have a couple of thoughts here. So one, to hear that a financial pundit is saying that we could go into recession happens pretty much every single day. Every single day, no matter how good things are, there's somebody say we're going to go into recession, and that's fine. I think it was 2022 when Bloomberg surveyed 88 economists. 88 economists out of 88 said we're going into recession over the course of the next year. And that did not happen. So economists get it wrong, market strategists get it wrong, pundits get it wrong. But it's always a pretty good interview when you're talking about the bad stuff that's happening in the world. Well, you can really point to any bad piece of data. And by the way, there's almost infinite data when it comes to the stock market and the economy. We get new info every single day that you can paint a narrative around. So the inverted yield curve, what is that? First of all, I call that the upside down yield curve. That just means that interest rates, instead of being low for, let's call it a 1-year bond, they are, and higher for a 10-year bond, they're flip-flopped. And we actually have higher interest rates in the short run and lower interest rates if you go out into the future. The thought there is that if it's inverted or upside down, rates should come, that's spelling some sort of financial slowdown, and that rates are going to have to come down. The Fed's going to have to lower rates because the economy is slowing down. The problem with looking at just that one indicator is it's been inverted for over 2.5 years, and we still have not gotten a recession. So that's number one. Number two, I've heard a lot of buzz around bankruptcy filings going up. And so I looked into that number, and yes, on the surface, bankruptcy filings for companies in the United States are up 40%. Whoa, wait a minute. That does sound scary. 40%. They've gone from 14,000 on an annual basis up to about 20,000. Well, wait a minute, that doesn't sound great. But if you zoom out and look over the course of the last 30 years, most of the time you see anywhere from 40 to 60,000 bankruptcies in any given year. So where we are today is actually very low on a historical basis when it comes to businesses not doing well. Again, you can point to it and say it spells doom and gloom. I just don't think it does. So I think we always have to be careful. I think the larger point here is that somebody's always predicting a recession because there will be a recession in the future. It just doesn't mean that any given pundit really has their arms around why or when it's going to happen. And as investors, we need to believe that over time, that's okay. Recessions happen. They're natural. The good news is the U.S. gets through them and comes out on the other side, and we recover from recessions. And going back to not trying to time the market, good equity investors over time are patient, and they're able to see through that and know that there's good news on the horizon eventually.
Scary headlines sell, and having topics where you get people riled up also is good for ratings.
Yeah, it's good.
So, all right, we'll go to this one from Jason in Illinois. I have a 401k account with Fidelity from a previous employer that has about $100,000 invested in a target date fund. My financial advisor has recommended that I roll these funds into an account called a variable and index-linked deferred annuity contract. He stated that there are no fees with this account and that the account will perform similarly to my 401k in an up market, and the account offers downside protection. What's the catch here? I requested the plan documents and got a 146-page book to review. My gut is telling me to stay away from this, but I wanted your expert advice.
Wow, 146 pages for a product. Again, it sounds a little bit like it's promising everything.
Sounds amazing.
The advisor is saying that first of all, this is an insurance product, not an investment product. Just because there is this thought that the value could go up, I think it gets misconstrued as an investment. And in a lot of ways, you could call it an investment because you're putting money in, you expect some rate of return. However, an annuity, then this is a mouthful again. Christa, what was the equity index linked equity market?
Yeah, it's
variable
and index-linked deferred annuity contract.
Okay, so it's got 7 words in it. A variable and equity index. So the other thought here is that the advisor is saying that there's no cost. That's literally almost never the case. There's always some sort of cost.
Yeah.
That's one.
Liar, pants on fire, potentially.
So there's a lack of transparency there. It's an insurance contract, not an investment, number 2. Number 3 is the thought that it should perform and do just as well as your 401k, but without the risk. That's perhaps the biggest pothole in this whole issue, is that there is no such thing. The reason we end up making 8 or 9% over time in the equity markets, broadly diversified stocks, is because we have to live with a fair amount of choppiness, volatility, and risk. So without risk, there is no such thing as these double-digit rates of returns over time. So a product can try to mimic this or say it's going to do that, but there's really no formula for a no-risk investment that'll do just as well as the stock market. Otherwise, everyone would do it all the time. So I'm seeing some lack of transparency in a lot of different ways in what this person is being recommended, and that makes me run a different direction. What I would tell folks is that I think that transparency with your financial advisor is so important. Advisors should be on your same side. Advisors should be an open book and tell you what investments cost. There's always going to be some sort of cost. And I think it's important for an advisor to disclose that and not try to kind of sweep it under the rug. And it sounds like when someone says there's no cost to a product that has a 146-page prospectus, that's a lot of red flags all at once.
All right. Well, we're going to take a quick break. We'll come back. You've got some more great info, and then I've got some Social Security questions to pose to you.
Let's do it.
All right. Welcome back to the Clark Howard Show. I'm Christa Diaz here with Wes Moss, and we're going to get into our second topic and then some more of your investment questions.
Ready to go?
Ready. Let's do it.
So now you want me to talk about another topic here?
Yes.
Okay, I've got one.
I know you do. You always have topics.
And I was thinking again, investing's hard. There's so many things that are trying to derail us. There's pundits forecasting doom and gloom. There are big market corrections. And it really we have to constantly remind ourselves that this is an ultra marathon. It's not just a marathon, it's an ultra marathon. And that's really how we end up winning over time and investing to protect our purchasing power and outpace inflation. So I want to make sure I always want to remind us that, I always want to remind investors that we've got to be there when the market does well. And we don't want to miss the best days. That can dramatically ruin our market returns over time. But what is the buffer that helps us do that? If you're 100% invested in stocks, and I'm not totally against that, and there are a lot of investors that are able to do that. They have strong stomachs and high risk tolerance, and they're totally fine with all the ups and downs of markets. But for a lot of Americans, a lot of investors, it really helps to have some sort of buffer. We've heard about emergency cash. How much do I have to have in safety assets? I think of this as I want to talk about something I call the dry powder principle. And I think it helps us be better equity market investors as long as we have some safety. And that's where dry powder comes in. Dry powder as in the safety powder that we have to keep safe and dry for use at some point in the future. Any dry powder asset, the way I look at this, and we're going to look at this in the context of our overall investments. This is not your emergency fund in your bank account. These are safety assets in your 401k, in your retirement accounts, in your brokerage accounts. So the dry powder part of that is anything that has a high degree of safety. It doesn't necessarily need to be just sitting in cash, but things like U.S. Treasuries, high quality corporate bonds, high quality money markets that have it. There is some risk in money market mutual funds, but safety assets in bonds and cash that should give you some income, some rate of return, but they have a very low level of downside in any given market cycle. Now, bonds can have some downside, but a bad year for bonds could be a bad month for stock. So I still consider high quality bonds as part of my dry powder. And what I would like to see, and I think this helps us, is if we've got our dry powder, it allows us to be stock investors on the other side and get through volatile times, which we know are always coming. They're always around the corner. There's no such thing as an escalator higher in the stock market. So I want to have some dry powder. How much should I have? My rule of thumb here is to have 3 years worth of dry powder in your investment overall portfolio. And I think that becomes even more important the closer you get to retirement. If you're 25, do you really need dry powder in your 401k? I don't think so. I think you should be mostly stock invested, if you can stomach that. But as you get closer to retirement, you really need this buffer or this cushion or these shock absorbers. And here's how I would look at it. You want to have 3 years of spending in your dry powder allocation of the portfolio. So imagine this. You need $100,000. I'm going to use round numbers here. You have $100,000. You need $100,000 a year. So the simple math there would just be you need 3 times 100 is $300,000 in your overall investment portfolio should be allocated towards safety assets or dry powder. But it's a little more nuanced than that. Imagine you have other income streams that are also highly regular and they're safe. Social Security for you, Social Security for your spouse. Maybe there's a pension or some other sort of income. And you have, again, round numbers here, $50,000 a year coming in, but you need 100. So really, your dry powder need is not for a full 100 because you already have 50 coming in. Now your spending need is really only $50,000 that you would need to take from the portfolio. So now we multiply. So we take our total need minus our cash flow that we know we're going to get, and that leaves us with a number that we multiply by 3, and that's your dry powder number. So in this case, I need 100. 50's coming in, 50's left. 50 times 3 is $150,000. So if you have a $300,000 portfolio, maybe it makes sense to have about half of it or $150,000 in dry powder. If it's $1 million portfolio, you would only need about 15% in that dry powder. And I think that in any given case here, the key is that if you know in the back of your mind that, gosh, things can go wrong for a month or even a year in the stock market, but that's okay because I have 3 years worth of spending already covered, already in safety assets. So it allows me to ride through a choppy, scary period of time in the economy and the stock market. And I think that buffer and that mental state makes us better investors on the stock side.
Okay. And you mentioned Social Security. So I'm going to hit you with a couple questions that came in. I know you know a lot about that. Dale in Florida said, I recently came across this YouTube video that contradicts Clark's advice of waiting to collect Social Security. I did send you this video in advance so you could look at it. I know it may be a bit unorthodox to watch this video before giving your response, but I really think there's a lot of folks out there who, like me, need your expert opinion on the fact that this YouTuber is recommending to go ahead and collect Social Security at 62 and that waiting is a scam in all caps.
I feel like that's a Clark word. Like that's
scam.
Wow. So I did watch the video and it's a good video. And the YouTuber in this case is someone who's retired down in Florida. And really, this is just his opinion. I think it's a pretty drastic one to call collecting Social Security at 62 if you don't collect at 62, it's a scam.
Yeah.
But he makes a couple of good points. So first of all, I think that we think about Social Security in this way of, we think of it, how do I maximize my Social Security? How do I maximize my Social Security? When really the question for most Americans planning for retirement is how do I optimize my Social Security? So we know how to maximize it. We wait till we're age 70, then that means that's as high as it's going to go. And then we live a really long time.
Yes.
And that's the operative word here. We got to live to get the Social Security. And that's really at the crux of the video. What the video is saying, this YouTuber is saying, I don't know. He's saying, I don't know how long I'm going to live and I want the money today. And what if I only live till I'm 75? Then I'm ahead if I took Social Security at 62. And he makes this point of him taking Social Security at 62, $1,700 a month. And his fictional twin brother waits till 67. So 5 years later. Well, but he said, by the time my twin starts, I've already collected a little over 100 grand. So how can I not be winning? And then it takes his brother until age 80 before they essentially break even. If we wait to take Social Security, whether we wait a month or we wait 6 months or we wait multiple years, the math works out just about the same. It takes about 12 to 13 years to recoup the money through these now higher payments because you waited to break even. And so his point is that we don't know. His point really is about longevity. It's all about longevity. You don't know how long you're going to live. And if you don't make it till deep into your 80s, then he makes a really good case to go ahead and take Social Security at 62. But it's one extreme. Taking Social Security at 62 is kind of an extreme way to do it. And if you're working, I think it makes no sense to take Social Security because we get penalized.
Right.
We get penalized. We can only make about $22,520 if we're taking Social Security before our FRA or full retirement age. And then it gets penalized. So for every $2 we make, we get penalized $1 in Social Security. Now you do get to make that back, but you don't get to make it back. You actually make it back slowly over your entire lifetime once you start collecting. So the point here is that we don't know our longevity, but the reality here is I think a lot of us are betting that we are going to live a long time.
Or we might have a spouse, right? Doesn't that affect things?
And even more, and this goes around optimizing social and not just maximizing my social, is that maybe it really makes sense for if your spouse's Social Security is really low and your spouse is younger than you, and it's going to be a really impactful thing, whatever your Social Security, your spousal benefit will be to your spouse once you pass away. And that leans towards waiting longer and making sure that payment is as high as possible as a little bit of an income insurance policy, not just for you, but if you're not here, for your spouse. So the conversation around Social Security really is about your particular situation with you, your spouse, your family, your other assets. So we could argue all day that, of course, wait till 70 to maximize, or the YouTuber that's saying, take it today or as soon as you can, or else you're crazy. Usually the answer is somewhere in the middle. It's about optimizing when social's right for you, as opposed to just thinking of it in a maximization way.
Yeah. So maybe even sitting down with a financial planner just to like look at everything one time would be helpful so that you know what your situation is and sort of get a better picture.
Yes. The other thing too, so first of all, planning is so important. A little bit of planning, Christa, as you know, goes such a long way. And if you run a financial plan, you can say, well, what if I take this at 62 and I lock in this smaller number? Or what if I wait till I'm 67 and I have a higher number, but now you need to use a little bit more of my money? So one argument, there's great arguments on both sides to wait or take it now, wait or take it now. One of the arguments to take it earlier would be if you have to drain your retirement assets to the tune of 10 or 15% early in your retirement, but Social Security allows you to get closer to that 4% safety level, 4% withdrawal rule, then sometimes it would lean towards taking social early. Mm-hmm. But if that's not the case, then there's Clark makes a great point that we have this huge increase, 7.5% to 8% per year for every year we wait. Mm-hmm. And for those with some longevity, then it's hard to argue against waiting, like Clark says. Reality here is it's individualized mm-hmm. for everyone and every family. And that's why it's really important to go ahead and sit down and do a little bit of planning around it. When does taking Social Security make the most sense for you?
All right, I'm going to hit you with another one from Chris in Texas. Can you explain the earning limit for taking Social Security before full retirement age? If you still work full-time, does it make sense to pay back some Social Security?
So the earnings limit here, so this goes back to your FRA, your full retirement age. And as we just talked about, we can take social at 62, or we can wait all the way to age 70, or we can take it somewhere in between. And when you get that Social Security statement, I don't know if they still come in the mail or not. I always log in to Social Security.
Yeah, I think you can decide.
I think they sometimes will send it still in the mail, but you can go online and look at your Social Security statement. And that's why you have this they've made it better. They have this nice little bar chart.
Yeah, I like it.
That shows how much you get per month for every year at different ages. Mm-hmm. So for most folks that are watching, as the FRA goes up and up, the younger you are, it's going to be age 67. So that means between age 62, when you can start taking social, and 67, when you get to your full retirement age, if you're earning money at work between 62 and 67, there's only so much you can earn without getting penalized. And that number right now is around $22,500 per year. So so in an ideal world, if you're just working part-time and you're making $20,000 a year, you could also take your Social Security, and you don't have to worry about a penalty. But if you're making above that level, say you're making $50,000 a year and you're taking a Social Security, then you could see a lot of that Social Security payment get wiped out. Mm-hmm. Now, you do get that money back. You do get that money back, but it takes your entire retirement and your life expectancy to slowly get that. You get a little bit more per month. So I don't know if I like that. So really, the way I look at it is either if you're going to take Social Security before your FRA, before 67, you don't want to earn any more than about $22,000, or else it gets penalized. And if you're going to make more than that, you probably do not want to kick in Social Security until you get to your FRA.
Awesome. Well, Wes, I cannot thank you enough. I know Clark thanks you from his long weekend. I thank you, Clark,
for having me here. It was awesome. Yeah.
He got a long weekend out of it. You're wonderful. I'm so glad, and I hope that you'll do this again because, Clark likes to travel, as he talks about on the show.
He's the best traveler in the world. Every time I think about traveling, I still think about Clark. Well, what would Clark do? How should I buy this ticket? Where should I go?
You could just call him or text him.
I know, but I don't want to bug him.
Thank you so much for being with us. If you have feedback, send it in through the Ask Clark form. Clark will be back tomorrow. And I hope the rest of your day is great.